Hey everyone, welcome back to the channel. Today, we're diving into a powerful combination that can save you thousands, if not millions of dollars in taxes as a real estate investor. If you've ever sold a property and reinvested in a new one, you might be familiar with Section 131 exchanges. But have you ever considered combining a 1031 exchange with a cost segregation study? Well, stick around because this could be the strategy that takes your real estate game to the next level. So, let's start with the basics. What is a Section 131 exchange? In simple terms, a Section 1031 exchange allows you to sell a piece of appreciated real estate and defer paying capital gains taxes by reinvesting the proceeds into a new like-kind property. Sounds like a good deal, right? But there's a way to make it even better. Here's where it gets interesting. Imagine you've sold a property for a significant gain. Let's say you bought a rental property for $200,000 a few years back, and it's now worth $500,000. After depreciation, your adjusted basis is $170,000, which means you're looking at a taxable gain of $330,000 if you sell it outright. But instead of selling it outright and getting hit with a hefty tax bill, you can use a Section 131 exchange to defer those taxes by rolling the proceeds into a new property. For example, let's say you purchase an 8-unit apartment building for $1,000 with that money. Boom! No taxes due, at least for now. But wait, there's more. Let's talk about cost segregation. This is a technique that breaks down the various components of your new property into different categories, each with its own depreciation schedule. Instead of depreciating the entire building over 27.5 years for residential property or 39 years for commercial property, you can speed up deductions by breaking out parts of the building, like appliances, lighting systems, and flooring, which may qualify for shorter depreciation periods, sometimes even for immediate write-offs. For instance, if you purchase that $1,000 apartment building, a cost segregation study might determine that $200,000 of that building is eligible for faster depreciation. Under the current tax law, that $200,000 could be deducted immediately thanks to bonus depreciation. This leads us to the million-dollar question: can you combine a Section 131 exchange with a cost segregation study to maximize your tax savings? The answer is yes, but there's a crucial step you need to take. When you do a 1031 exchange, the IRS allows you to calculate the basis of your new property in two ways. The first method, known as the Track 2 Assets method, lets you continue depreciating the basis of your property while starting a new depreciation schedule for the additional basis of the new property. The second method, called the Track 1 Asset method, lets you combine the basis of your old property with the new one and treat it as a single asset. So why does this matter? If you plan to use cost segregation on the newly acquired property, you might want to choose the Track 1 Asset method. This method allows the entire combined basis to benefit from cost segregation, potentially leading to huge upfront deductions. Let's look at an example. If you combine the bases and the cost segregation study shows that 25% of the combined basis qualifies for immediate deduction, you could write off $142,500 right away. That's money you can use now rather than slowly depreciating over decades. But as always, it's important to consider your long-term plans. If you expect to sell the property within a few years, the tax benefits might be recaptured, potentially reducing the benefit of the cost segregation. On the other hand, if you plan to hold onto the property for a long time, or even until death, This strategy can provide incredible tax savings, especially when combined with the stepped-up basis your heirs might receive. To sum it up, combining a Section 120 exchange with a cost segregation study can be a game changer for real estate investors. It allows you to defer taxes, accelerate deductions, and maximize your investment potential. But remember, it's essential to consult with a tax professional who understands the intricacies of these strategies to ensure you're making the best decision for your specific situation. And that's it for today's video. If you found this information helpful, make sure to hit that like button and subscribe for more tips on how to make the most of your real estate investments. Got questions or suggestions for future topics? Drop them in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next video. Until next time, keep maximizing those investments.